Okay, so this video is just going to provide a short overview of Fringe Benefits Tax, or FBT, and how it works. So FBT applies to the employer. So the employer has the obligation to work out what the FBT is and then pay it to the ATO. The Fringe Benefits Tax year is from the 1st of April to the 31st of March. So for some reason this is different to the income tax year, but it works in the same way. So the aim of the Fringe Benefits Tax is to tax the private benefit that an employer provides to an employee or an employee's associate. So what this means is that if your employer provides a private benefit not related to work to the employee, then it's subject to FBT. So for example, if I was your employer and I gave you a fully funded holiday, then it's obviously a private benefit to you, and so it'd be subject to FBT. Now, some benefits can also be partly used for work purposes, but they also provide a private benefit. So for example, if your employer provides you a car, you might use that for work purposes, but then at times you might also use that for private uses. So the private use portion is what would be subject to FBT. Benefits are usually non-cash when they come subject to FBT, but they still can be cash as well. Now, the fringe benefit tax that an employer actually pays to the tax office is deductible on the employer's income tax return. So if the employer pays $5,000 of fringe benefits tax to the ATO, they would then use that $5,000 as a deduction off their assessable income. So exemptions for FBT, simplest one is salary or wages, which includes allowances. So these are covered under income tax legislation, and so you include these obviously on your personal income tax return. Now, allowances can be a little bit confusing. So if you were to receive a weekly travel allowance, say $20 a week, for example. Now, if you receive this allowance, regardless of whether or not you actually spent any money on traveling, then this means that you'd include this on your personal income tax return, and so it wouldn't be subject to FBT. If the allowance is specific to the money you spend, then it would potentially be considered under FBT. So super benefits that your employer pays into your super fund, they're exempt from FBT, dealt with under the superannuation legislation. Capital benefits dealt with under the capital gains tax legislation, so again, exempt from FBT. So an example of capital benefit might be your employer pays you $6,000 upon your termination, say, to restrict you from working with a competitor for 6 months. So that would be of capital nature, and so you consider that a capital gain, and so that would be exempt from FBT. There's also a number of benefits which are considered exempt by FBT rules, which are just specified in legislation. So there's some key terminology when considering the fringe benefits tax. So firstly, there's taxable value. So this is simply the value of the benefit which is subject to tax. So we'll go through working out the taxable value and some examples in some other videos. Next, there's grossed up taxable value, which is equal to the taxable value multiplied by the gross rate. So taxable value is what we just spoke about then. The gross up rate is simply an arbitrary number specified by the tax office that you gross up the taxable value by. So the gross up rate's provided in a set of tables, so it's easy to find and just to put into your calculation. Next, fringe benefits tax is equal to grossed up taxable value multiplied by the FBT rate. So this is the actual amount of fringe benefits tax that the employer would pay to the ATO. Okay, so in actually calculating your fringe benefits tax, the steps you take are that firstly, you need to work out if there actually is a fringe benefit. If there isn't, well then it's not subject to FBT and you stop. If there is, then you continue on And the second step is to work out what its taxable value is. Now the methods for working out taxable value are specified specifically for each fringe benefit, so we'll go over that with some examples in later videos. Next, you need to gross up the taxable value. This can be type 1 or type 2, so we'll go through that in a second. And finally, you calculate what your actual fringe benefits tax obligation is. So when you're grossing up taxable value, as I just mentioned, there's type 1 or type 2. So type 1 gross up is when the provider is entitled to a GST credit. So this is when they purchase taxable or GST-free supplies. So if you want to learn more about that, you can watch the GST video. And type 2 is when the provider is not entitled to claim a GST credit. So this is for input tax supplies. So simply the ATO provides gross up values for type 1 and type 2 in separate tables. So you just look at which table is relevant for the question. Okay, so that's a general overview of how FBT works. I'll be going through some examples for specific fringe benefits in some other videos.